Hello friends, I am Dr. Pragnesh. So there are six categories of the stocks. We will discuss fast growers in this lecture. Six categories of the stocks are slow growers, stalwarts, fast growers, cyclical, turnarounds, and asset play. We have discussed all other five categories in previous lecture. So we will do exclusive discussion on fast growers. This is the only category in which I prefer to invest. If you choose wisely, this is the land of 10 to 20 beggars, and in small portfolio, two or three of these can make career. The characteristics of the fast growers are there will be increase in the net profit, operating profit and sales. The operating margin will be either stable or it will be increasing. So this is the screener application. We can see the profit and loss statement. On the column we can see the sales, operating profit, operating margin and net profit. While in the row we can see the various years profit and loss statement. That here we can see the 2019, 2020, 2021 and 2022. So we can see the last 10 to 11 years data in this application. So this is the graph of KEI Industries, that is typical growth stock. We can see its chart. So the sales, the operating profit and operating margin on the screener application, the sales are increasing from 1100 crores to 4100 crores. Same way the operating profit is also increasing from 88 crores to 456 crores. The operating margin is from 8%, then 9%, then 10%, and then it is 10%, almost stable 10% in last 6 to 7 years. The net profit of the KI industry, we can see it is in 2011 it is 11 crore, then 26 crores, then 34 crores, then 145 crores, then 255 crores and 270 crores. So the net profit is also increasing in last 10 to 11 years. This is graph of Nalco. We can see it is typical cyclical graph. It is like the mountains, so that is indicative of cyclical stock. The net profit of Nalco we can see from 2011 to 2021, it is 640 crores, then 1300 crores, then 700 crores, then 1300 crores, then 2900 crores. So it is increasing, then decreasing, further it is increasing and further decreasing. That is typical indicative of cyclical stock. So we will see details of the growth stocks in this lecture, and we will discuss why 20% growers are more preferable than 30 to 40% growers. Why it is important to differentiate consistent growers from temporary growers. How to avoid companies like HEG and avoid huge losses. Why most legend investors advise to invest in dull slow growth industry and they advise to avoid hot industries. Why it is important to take consideration of other income, depreciation and interest in profit and loss statement. How much we should pay for the fast growers, whether we should pay fair price, that is P around 20, or we should pay expensive price, that is P more than 30. How to calculate growth rate and why we should do averages of 3 years in calculation of growth rate. So we will discuss details in this lecture. Now first we will discuss how much growth rate. I like small company with profit growth of around 20 to 25% CAGR and sales growth more than 10% CAGR. So Peter Lynch says while 20% growth is sustainable over long duration and they give huge return especially over a period of time. This is the reason why 20 to 25% growers are my favorite stocks. So then why one should stay away from very high growth stocks, that is growth more than 30% CAGR? The first reason is very high growth is not sustainable. Growth more than 25 to 30% CAGR is difficult to achieve year by year in this competitive era. Such high growth and hot industry attract smart crowd that awake day and night to get into the business. If you don't have Nikkei or patent, then profit will be shrunken by huge competition. Market punishes very hard once the growth slows down. In short, it is very difficult for the companies to make 20 to 25 to 30% or more than 30% growth year by year. So company can have such high growth for 3 to 4 years, and after a few years the growth will slow down and the share price will also fall. In short, stay away from the very high growth stock. The second reason to avoid high growth stock is the valuation of these stocks are very high than their intrinsic value. And once the growth slows down, the valuation will also come down. And third reason is be suspicious of the companies having very high growth, that is growth more than 50 to 100%. Such high growth is almost impossible for long period because in these companies may be manipulating the profits. So beware of very high growth stocks. It is very difficult for the companies to having growth more than 50% year by year. Now, second thing we will see about the growth stocks are the consistent growth since last 10 years. So there are two type of the fast growers, consistent growers and the temporary growers. The consistent growth is due to the moat, that is competitive advantage of the company, while temporary growth is mostly due to demand supply mismatch. We will see details. So this is the profit and loss statement of LT Foods, that is growth stock. We can see its net profit from 2011 it was around 60 crores, then 85 crores, then 72 crores, then 144 crores, then 199 crores, then 309 crores. So it is increasing and at least around more than 15 to 25% growth. While the other company we can see the average to organic its growth is only during 2019 to 2021, that is 2 crores, then 8 crores, then 11 crores, and then 14 crores. Out of these 4 years there was no growth at all in this last 10 years period, so it is growing temporary. So we have to differentiate these temporary growing companies due to demand supply mismatch from consistently growing company with inbuilt earning power and moat. Here LT Food with consistent growth has some moat, while temporary growth of average to organic was due to the increased demand of the medicines during corona time. So if by mistake you invest in such company, there is temporary growing. After few good quarters, profit of the company and so stock price will surely go down. We can see the graph of average to organic, it is also going down and parallel to the net profit. Now third thing about the growth stock, that is avoid companies with the sudden huge growth spurt. So we can see the HEG graph. Its operating profit is growing from 247 crores, then it is now going down like 180 crores, 137 crores, and 81 crores. It is cyclical stock, so it is okay. But in March 2018, the growth suddenly jumped to 1700 crores. Then it suddenly jumped to 4600 crores. So it is almost 20 times from 81 crores to 1070 crores. So there is sudden rise in the profit and then there is sudden fall in the profit. We can see the graph also, it is suddenly going up and then suddenly going down. So here HEG profit grew around 20 times, that is 2000% in 1 year. This growth rate is never sustainable. Sudden spurt of the growth in profit makes stock skyrocket, and then sudden drop in the profit makes stock going acutely downside. That is the reason why people make huge losses within short time by investing in stocks with sudden growth spurt. So avoid stocks with sudden and huge spurt in the growth. Rather invest in the companies having consistent and moderate growth. So avoid stocks with sudden growth spurt. Now we will see not growing every year. It is not possible for the companies to grow 20% every year. Company may have 1 or 2 years of flat growth. There may be stagnant years in between. This is the reason why we should consider average of the 3 years growth in calculating the growth. So we will see that in the end how to calculate the growth. Now let's take example of the GMM Fodler. In 2014 to 2016, the GMM Fodler has flat growth. that is 19 crores, 19 crores and 20 crores profit. Same way 2020 to 2022 the company has flat growth, that is 71 crore, 64 crore and 75 crore. Now if investor takes quarterly or the yearly results too seriously, then he may lose big opportunity, because the investor has sold GMM further on the basis of quarterly or the yearly result, then he may have lost around 7 times opportunity. So we will see in this graph, we have seen that from 2014 to 2016 we can see the red line. At that time the company has flat growth. Now if at the end of 2016, due to not growth since last 3 years, many may have sold the shares, and after 2016 the stock has made almost 7 times return. We can see the graph is only going up after that. So don't take yearly results too seriously. Instead, focus on 4 or 5 year averages. That is by Warren Buffett. Now we will see fast growth stock in slow growth industry. Peter Lynch says the fast growing company does not necessarily belong to the fast growing industry. I would like if it is in slow growth or even non growth industry, as it will not attract the competitors. Many people want to invest in high growth industry but not me. For any single product in high growing hot industry, thousands of the companies trying to figure out to make it cheap. That competition will kill the profit. This will not happen in slow growth industry. So moderate growers, that is 20 to 25% growers in slow growth or non-growth industry, is ideal investment. At present, we can see the electric vehicles and the solar are hot industries. So, very few companies of these industries will make profit in the long run. Huge profit will attract a huge number of the competitors, and that will kill the profit for most companies in the long run in such hot industries. So, better to avoid them rather than invest in the dull non growth industry. Sales growth. In above slides, we have discussed about the profit growth. However, sales growth is also important. If you have a company with tons of cash flow, but the top line, that is sales growth, is 5% or less, the stock does not go anywhere. So, companies should have at least 10% sales growth. We can see the sales growth in here in this profit and loss statement on the screener. The first, that is sales, that is 1600 crores, then 2000 crores, then 2600 crores, then 4200 crores, and 5700 crores. So it is increasing more than 10% CAGR. Same way, the operating growth is also important. Sometimes company may have higher appreciation or interest cost or the higher other income. So it is always better to take consideration of operating growth also. We can see the profit and loss statement of the KEI Industries. The operating profit, that is 440 crores, then 490 crores, then 456 crores, and 589 crores. We can see the other income, interest, depreciation, and tax that are the below the operating profit. That means they will not affect the operating profit. So operating profit will truly say about the company's growth. So because sometimes what happens, if there is higher other income, higher interest cost, so that will affect the net profit, but that will not affect the operating profit. So always check operating profit also. Now the how much will you pay for the growth? What do you like to buy, fast grower or slow grower? Definitely we all like the fast grower. As most people like to buy fast growers, we cannot buy them at cheap valuation. 20% grower available at 20p is better buy than 10% grower available at 10p. So it means fast growers will be available at higher valuation than the slow growers, and we have to pay extra to buy them. How it means buy fast growers at reasonably fair price but not at expensive price. We will see detail on the valuation and P ratio in other lecture. It is far better to buy a wonderful company at a fair price than a fair company at wonderful price. So, if you are not getting stock at cheap price, buy at fair and reasonable price, but not at expensive price. And second thing, Always buy stocks of good businesses. Don't compromise in business quality. Now we will discuss how to calculate the growth rate. Growth to be seen in sales, operating profit, and net profit that we have seen previously. I generally calculate the growth for 3 years, 5 years, and 10 years duration. So we will see the Moltec Packaging Company, its 5 years profit growth from 2016 to 2021. So for 2016, we have to take averages of 2015, 16, and 17. And for 2021, we have to take the averages of 2020, 21, and 22. This is the screener application. We have already discussed it. So first we will calculate the averages of 2015, 16, and 17. Here 17 crores, 24 crores, and 27 crores. The average is 22 crores. Same way for 2021, we will do average of 20, 21, and 22. So the average is 50 crores. So we will put this 22 crores and 50 crores in CAGR application that is available in Play Store. The year's duration is 5 years. So we will have CAGR return that is 17.84%. So how we can calculate the growth rate. The summary is the fast growers. Moderate growers that is 20 to 25% with consistent growth in slow growth industry is ideal investment. Avoid stocks with growth more than 30% CAGR. Avoid stocks with sudden spurt in profit or operating margin. Avoid temporary growers, check growth for past 10 years and invest in consistent growers. We have discussed about the stalwart cyclicals in previous lecture. So the stalwarts, people who don't want to take the risk of small caps growth stocks can invest in stalwarts. High dividend stocks, we have seen in previous lecture, companies give high dividend at the cost of growth. At the end, you will get 8 to 12% CAGR return from high dividend stocks. We have discussed detail about high dividend paying stocks in previous lecture. Those who require regular passive income should invest in high dividend stocks. Most of us like dividends, but actually dividends are expensive luxury for the investor seeking maximum growth. So dividend is always at the cost of growth. And people who want to passive income should invest dividend paying stocks. Turnaround, so avoid turnaround stocks. Even Warren Buffett always says avoid turnarounds. Cyclicals, avoid cyclicals, especially if you are long term investors. Those who are working in cyclical industry like steel, paper, sugar should invest in respective industry. For others it is better to avoid. And penny stocks, avoid penny stocks, that is stocks below 10-20 rupees stocks. So this video is only for educational purpose. Take experts opinion before investing. Subscribe my channel for next series of lectures. Thanks.